Nike is the dominant athletic footwear company in the world by a wide margin, and their stock price went down 20% on last week's trading at the end of the week after the company announced their earnings. Wow, 20%. Is it time to cut bait and get out of this stock? Or is it time to buy more shares and buy into this company since it's being discounted? That's what I want to answer in this video. I'm going to analyze Nike, go through my whole process of looking at the company, and then I'll make a decision whether I should sell the shares that I currently have, buy more, or just hold. Let's get into it. So, first, I'm an individual investor. Nothing of what I do or say is investment advice. I don't recommend you buy Nike, don't recommend you sell it, don't recommend anything related to financial actions around Nike. I also have a sponsor, Mumu, who sponsors my channel, and I appreciate that. They're offering new account holders a really nice offer where they'll pay you 8.1% on your cash that you hold with Mumu. They'll also, after 3 months, that's an introductory rate, they'll pay 5.1. They'll give 15 stocks to new account holders that put in more than $1,000. And that's a pretty good offer combined with an 8.1 and then 15 free stocks. Take a look in the details of the video if you're interested in that offer. Now, Nike. So Nike clearly is the dominant company when it comes to athletic footwear. You can look at any sport, just about most of the athletes wear Nike. They have the strongest brand, and the margin between the value and power of their brand compared to Adidas, which is probably in second place, or Puma. There's some brands out there that they're recognizable, but nowhere near the power of Nike, especially here in the United States. But I imagine it's the same around the world. So the company is recognized, and their shoes are held in a higher desirability, I think, category than typical shoes, let's say from Adidas, Puma, and others. So that's one recognition, is that Nike has clearly a brand like a Coca-Cola. It's very recognized, and it gives them an advantage. Retailers want to carry Nike in their stores. Online companies want to carry Nikes on their websites. Athletes, they want to be endorsed by Nike. Their whole network effect is quite powerful compared to the other brands. And they had a movie come out recently. Matt Damon and Ben Affleck were the actors in that movie. And I really liked the story they told. At one point, Nike was small, and they really had to fight hard to be relevant in that case, basketball. And they certainly became relevant because they signed Michael Jordan, and they created the Air Jordan line of shoes, which have become just a huge, huge success for the company as well as Michael Jordan. So the company really got to where they're at by having great shoes, a great product, and having great partnerships, and really just being more creative, and probably just hungrier, harder working than their rivals. So the advantages that Nike has as a business are really desirable to me. I think it's a company with a strong, wide, competitive moat. Companies cannot compare against Nike. If Nike were to falter for 5-10 years and another company really performed really well, maybe at that point you could see that their moat would be threatened. But as so long as Nike continues to do what they do, which is really dominate the professional sports endorsement game, dominate, the retail shelf space that they command, dominate online sales, dominate direct sales to their consumers, I don't think their moat is going to be threatened. So I really like the company, and I really like their competitive moat. Their balance sheet. Their balance sheet's excellent. They have almost as much cash. Actually, they have more cash than they do debt. So they can pay off debt immediately. And EBITDA, they make almost as much EBITDA as they have of debt. So they could pay off debt in almost 1 year. So that's a very strong balance sheet. On their earnings, they announced that they reduced their inventory. So that's just one more element of making their balance sheet even stronger. Because the lower the inventory a company has, the lower the risk of that company having a write-off of their inventory for inventory that's become stale and less desirable. So all things are good with the balance sheet. So really good company, good balance sheet. Now let's talk about the discount of the stock. And I value Nike using two methods. One is using the free cash flow method, meaning look at the free cash flow that I expect the company is going to produce in the future, discount those free cash flows, get to a value of what that company is worth. The other is to look at earnings per share, value the company based on the earnings per share that I expect the company is going to provide. Free cash flow looks really good. Their trailing 12 months, a free cash flow is $6.9 billion. And I'm going to grow that by 10% because they have been just performing really well. They are putting more cash on the balance sheet every quarter, very profitable. They have certain products that are very mature and they generate a lot of cash. So next 4 years, I expect they're going to grow free cash flows by 10%. And then after year 4, grow at 4%. It's a really strong company. So I'm going to discount all those free cash flows that I expect by only 8%. I get to a value of all those free cash flows of nearly $190 billion. I'm going to add the cash on the balance sheet, which is 11.6 billion, and take away debt, which is 8.9 billion. We get to an equity value of the company of 192.5 billion. The current market cap of the company is 113.7 billion. So there's a 69% discount if we look at the company based on free cash flows. So that's a really strong discount. The earnings per share. First, a lot of analysts cover Nike, and it is a stock that they believe is discounted. I'm going to use the forecasted earnings per share for the current year, which is $3.79. I'm going to give them a PE of 24 and a growth rate of 4%. It gives us a value per share of $94.60, and the current stock price is $75. The discount using the earnings per share method is 26%. So both methods provide a discount, and the free cash flow method provides a greater discount. Now, I put more weight in free cash flows because I believe that's the truest measure of the value of a company. I put 2/3 weight on free cash flow method, 1/3 on earnings per share. When I combine those two valuations, I get a 55% discount on Nike. It's a very attractive discount on this company. Let me add a few more fundamentals that I like to track. First, momentum. The momentum is not with Nike. Their stock is down 20% in the last month. Part of it is this past week. It was really a bad week. So momentum is against Nike. I think the stock may continue to drop. The business risk for the company is low. The return on invested capital looks really good, 19%. That's exceptional. The earnings yield is very good, 5%. The free cash flow yield is very good at 6.1%. Now, as I look at Nike, I like owning premium companies, and you get them at a discount when times are tough. And times have gotten tough for Nike. This past week, a drop of 20% is really substantial. I read through the earnings, and yes, the company did not grow much. They grew a tiny bit in this most recently closed year. They just closed their fiscal year that closed at the end of May. So having said that, it's a premium company. I love the company. I love the strong competitive moat. I love their balance sheet, and I love the discount. So I'm going to continue to buy Nike shares, and I'm going to buy in good quantities. I could see investing $50,000 to $100,000 in Nike because it is one of those companies where this may be the time when it's discounted, and we may not see it discounted again for another 5 years. So I want to take advantage of the current times and really load up on Nike. So that's my video on Nike. I hope you found it interesting, and I really appreciate you watching.